Hi, everyone. Dave Schiller, Aegis Wealth Partners here. Just wanted to share a video on subsidized and unsubsidized loans. What are they? So these are for federal direct loans for undergraduate students. So we are getting into the season where people are going to have a lot of questions. We have new families who are going to be applying to college for their students, and eventually they're going to get financial aid award letters, and they're going to wonder what are these subsidized and unsubsidized loans. So I wanted to go over what the difference is and some of the other basic information about what these loans are and what they're not. Okay, so for federal direct student loans, to be eligible to receive these loans, you have to fill out the FAFSA form. So this is required to become eligible for any federal financial aid, and that includes work study. So the FAFSA form is required. There is a borrowing limit for undergraduate students. Graduate students and parents are generally able to borrow the remaining amount of whatever need there is to pay those tuition and other school related fees. So here we see the loan limits for federal direct student loans. This is not broken out by subsidized and unsubsidized. This is the total amount. So for the first year, the most that a student can borrow for federal direct student loans is $5,500. Their second year, it's $6,500. And after that, it's $7,500 for a total of $31,000. If you are an independent student, there are different loan limit amounts. I'm not going to cover that information for independent students. You can go to studentaid.gov. A lot of times in these videos, you hear me referring to studentaid.gov. It is a treasure trove of information, and it is the official source for federal student aid. So always a good idea to look at that website, whether you are just starting the college planning process or whether you are graduated and are looking at paying your student loans back. Just a great source of information there. Now, subsidized student loans, these are available to undergraduate students who have demonstrated a financial need. And what that financial need is based on is the cost of attendance. So for most colleges, if you go to their website, they will have the cost of attendance. And then you subtract whatever other aid that you may be getting or other resources that you have, and then that's going to be your financial need. So if you have a financial need, and for many families, they will have a financial need, you can borrow direct loans for the student. The student can borrow them. The interest is paid by the federal government while the student is at least a half-time student. And then also during the grace period, which is generally going to be 6 months after they graduate or leave school, and also if they are in a deferment status. And then I have not forbearance. So there's two different statuses where a student is or a borrower is not paying deferment and forbearance. So the subsidized loans, there's no interest paid by the borrower while they are in deferment. And then if we go back to that original chart where we saw the loan limit amounts, well, this is the loan limit amount for the subsidized loan. So the first year of that $5,500, only $3,500 of that can be a subsidized loan. And you'll see that for the total amount of subsidized undergraduate loans, the most that a student can borrow is $23,000. Now, unsubsidized loans, these are going to be available also to undergraduate students, but also graduate students. So in general, graduate students are going to be considered an independent student, and therefore virtually all of their direct plus loans are going to be unsubsidized. Unlike the subsidized loans, these are not needs-based. So even if you just want to borrow that extra $2,000 you can do that. However, the interest is going to accrue immediately once that loan is dispersed. And so you see here the loan limit, $2,000 per year. So you look at the subsidized loan limit for an undergraduate student for federal direct loans. It's $23,000. We have $8,000 for the unsubsidized loans, and that's how we get the $31,000 for the total loan limit for a federal direct loan. So it's going to be a mix of both subsidized and unsubsidized loans. Now, the question is, should your child take out these loans? At the end of the day, this is a decision that you have to make as a family. I will list some of the reasons or some of the pros on why you should consider having your student take out the loans in their name. So first of all, they have skin in the game, but there's no credit check that's required for the student to get these loans. If they apply, if they're eligible and they apply, they will get those loans, assuming they filled out the FAFSA form. Now, you're going to get the lowest student loan rate, interest rate available for any of the federal loans. And when the student graduates, they're going to have an established credit history. So if they graduate, they want to buy a car, they want to rent an apartment, they have a credit history that's going to make that a lot easier. And it's going to, then they won't necessarily, they may still have to do a co-signer with the parent, but it's going to make it a lot easier on the parent and the student for them to have that established credit history when they graduate. Now, here's a little tip that for those families that don't want their students to take out the loans, or they have the means to pay those loans off when they graduate, when the students graduated and the parents have the means to do this. If they want to pay off the loans immediately after they're dispersed, they can do that. And the student is still going to have that established credit history. So it's a little tactic that you can use, but just keep in mind, again, there's going to have to be that established financial need for the subsidized loans. But again, this is something that some parents will manage to do so that their children don't come out of college with student loans, but then they have the credit history. As a federal student loan borrower, you're going to be eligible for forbearance and deferral options. Generally not the case if you have private student loans. You will have income-driven repayment plan options. Again, that is definitely not the case with private student loans. And you most certainly will have better consumer protection laws backing you up for federal student loans. So how can you use the federal direct loan limits and use that for college planning? Well, in an ideal situation, you're going to be looking at schools where your remaining need, after all of your other aid and other resources, you subtract that from your cost of attendance. The ideal situation is that whatever your remaining need is, you can use those federal direct loans to pay that need, and there's no other need after that. Now, that's not always going to be the case, but that's going to be an ideal situation. So what you can do, and what we will always do for our clients, is that we will help to identify schools that may not initially be on their college list, right? Students are going to come in, they want to go to this school, they want to go to that school, parents want them to go to certain schools, and that's fine. But what we will also do for our clients is we'll help them build a list of schools that will be good financial fits and also academic fits, right? So we want to understand, is the student a merit candidate? Is the student a needs-based candidate? And identify the schools that are good at giving award for either merit or needs-based candidates. And so we will identify some schools where we can position those direct loans for the students so that they come out with if not no student loans aside from the direct loans, or very little above that. So ideally what we want to do is we want to try to limit the amount that they borrow to their expected first year salary. And so that's kind of how we approach borrowing, and especially with the direct loans, and trying to plan for which schools are going to be a good fit for the student. And so I know there's a lot of students out there. They're looking at the brag schools. Parents certainly love to be able to talk to their friends about, their child being accepted to Harvard or Stanford or MIT. But there are a lot of really, really good schools who can provide some really competitive financial aid packages. And that's one of the things that we try to do. And that's something that you can do as well when you're trying to consider how much you may have to borrow and how you're planning on selecting the college for your student. And, of course, that's going to be, a decision that ultimately rests with the student and the parents. So anyway, I hope that helped a little bit to clarify the difference between a subsidized and an unsubsidized loan. So essentially is interest paid by the government while you're in school? And how does that apply to the federal direct loans for the undergraduate students? So anyway, again, I hope it helped. You have my contact information here. If you want to reach out, you can set up a meeting if you want to talk further, or if you just have some questions. Happy to help. But until next time, we'll catch you on the next video. Thanks.